Hey everyone, my name is Mark Gerber. I am a certified financial planner on the Jacob Young Financial team, and I really appreciate you taking the time to watch this. Let's make it worth your while. I want to set the tone right up front. This has been one of the more eventful stretches in recent memory. A genuine geopolitical conflict, an oil supply shock, a big market sell off, and then a pretty remarkable recovery, all in the span of about 6 weeks. We've had clients call us, we've had clients email us, and the underlying question is always the same. What does this mean for my money? That's exactly what we're going to answer today. We'll walk through what happened, where things stand right now, and most importantly, what we think you should actually be doing because of it. So let's get into it. Here's our roadmap. We're going to cover four things. First, where we are today, because the numbers right now look very different from what you may have seen back in March. Second, the economy and the Fed, because what the Federal Reserve does next has a real impact on your portfolio and your financial plan. Third, we'll look ahead at earnings and fundamentals. And finally, we're going to get practical because all of this only matters if we connect it back to your situation. Let's start with where we are right now. So let's look at the headline numbers as of right now. The S&P 500 is up somewhere in the range of 4 to 5% for the year. Now, I know some of you are thinking, wait, wasn't it way down not too long ago? And you're right. We had a pretty sharp sell off earlier in the year, and the index has since rallied back to positive territory. We'll explain exactly why in a moment. The 10-year Treasury yield is sitting at about 4.26%. That's actually come down from where it was a few weeks ago when inflation fears were running hot. And crude oil is right around $89 a barrel today, which is still elevated compared to where it started the year at around 70, but it's well off the peak we saw during the worst of the conflict. These three numbers together tell you a lot. Markets have worked through a lot of fear and uncertainty in a short period of time. The question is whether that resilience holds. Let's dig into what's been driving all of this. The dominant story of early 2026 has been the US Iran conflict, which escalated on February 28th to the point where the Strait of Hormuz was effectively shut down. For context, the strait is essentially the funnel through which about 20% of the world's oil and LNG flows. The IEA called it the largest oil supply disruption in market history. We're talking about roughly 13 million barrels per day being disrupted. To put that into perspective, Saudi Arabia produces around 10 million barrels a day. This was a massive shock to global supply. Oil prices responded immediately. At the peak, WTI crude had spiked about 45%. Bond yields rose on inflation fears. Stocks were whipping around with every headline. It was a genuinely unsettling environment. Then, on April 7th, a ceasefire was reached, and the market reaction was swift. Oil dropped more than 10% in a single session. Stocks rallied hard. The 10-year yield pulled back. By the time we recorded this, the S&P 500 had moved back into positive territory for the year. But who knows what the rest of the year has for us. Here's the bigger picture, though. I want to be upfront about this. When we recorded this, the situation was still fluid. Peace talks were ongoing in Pakistan. Iran had declared the strait open, but the ceasefire was fragile, and there had already been flare ups over the weekend. By the time you're watching this, some of that may have resolved further or it may have gotten more complicated. Either way, the market has largely priced in a resolution, and the key dynamics we're walking through still apply. What we do know is that March CPI came in at 3.3% year over year, the highest since mid 2024, and almost entirely driven by energy. Core inflation, stripping out food and energy, came in at 2.6%, which is meaningfully more contained. That distinction matters a lot for what the Fed does next. Let's talk about the Fed. At the March meeting, they held rates right where they've been since late 2025, between 3.5 and 3.75%. That was the second straight hold after three cuts in the back half of last year. Nobody was surprised by that. Given everything happening with oil and inflation, it would have been very hard to justify a cut. The April meeting is coming up on April 28th and 29th, and the market is basically pricing in a 99% chance of another hold. That's as close to a sure thing as you can get in markets. So rates aren't moving next week. Now, here's where things get more interesting. Earlier in the year, the expectation was that the Fed would cut once in the second half of 2026. That expectation has largely evaporated. JP Morgan, among others, now sees the Fed on hold through the end of the year. The logic is straightforward. March CPI is running at 3.3%. Headline inflation expectations are rising, and the labor market is still pretty solid. There's no urgency to cut, and with energy prices still elevated, there's a real risk that inflation could stay sticky. The Fed did revise its 2026 PCE inflation forecast up to 2.7%. GDP growth is still projected at 2.4% for the year, so the economy is holding up fine. It's just not the environment where the Fed feels comfortable easing. There's also a leadership transitioning happening right now. Jerome Powell's term expires May 15th. Kevin Warsh, who is Trump's nominee to succeed him, is actually having a Senate confirmation hearing today at the time of this meeting, this recording. And it's complicated. There are some political obstacles to his confirmation, and there's real uncertainty about whether he'll be in place by May 15th. We're watching that closely because a Fed chair transition in the middle of an already uncertain period adds another layer to consider. The bottom line on the Fed, rates are staying put for now. The path to cuts has gotten narrower, and the policy direction from here will really depend on whether the Middle East situation resolves cleanly or drags on. All right, here's the part I actually want to spend some time on because I think it's the most important story for long term investors right now. Despite everything I've described, corporate America is in very good shape. Q1 2026 earnings season is just getting started, and about 10% of S&P 500 companies have reported so far, and 88% of them have beaten expectations. That's well above the historical average of around 78%. And earnings growth for Q1 is coming in at 13.2% year over year. That would mark the sixth consecutive quarter of double-digit earnings growth. That's a really impressive run. Profit margins are at 13.9%, which would be the highest level FactSet has ever tracked. The forward price to earnings ratio on the S&P 500 is at 20.9 times, which is above the historical average, but it's a number that's easier to justify when earnings are growing this fast. Now, I want to say something plainly here. The stock market earlier this year was down 6 or 7% at its worst point. That decline was not about earnings. It was not about the fundamentals of the companies in your portfolio. It was almost entirely about fear and uncertainty related to oil prices and geopolitical risk. When that fear started to ease, the market bounced back. That's actually how healthy markets are supposed to work. On AI, This is still a meaningful tailwind. Over 40% of S&P 500 companies are now using what's called agentic AI, which is AI that can actually take actions and make decisions autonomously, not just answer questions. That's showing up in operating margins in sectors you wouldn't necessarily expect, like customer discretionary and logistics. The Magnificent Seven still make up about a third of the S&P's market cap, but the earnings growth is broadening out. The rest of the index is starting to catch up. Looking at the full year, Wall Street consensus is now projecting about 18% earnings growth for 2026. That number has been going up, not down. The economy is expanding at a solid pace. There is no recession signal flashing right now. And when you look at history, years that have a rough or a volatile first quarter tend to recover and finish positive more often than not. Strong earnings and a resilient economy are the foundation here. That's what supports staying invested. So let's bring this home. What do we actually want you thinking about right now? Portfolio volatility and risk tolerance. If the last 6 weeks made you anxious enough that you were thinking about making changes, that's real and important information. Not about the market, but about you. We want to revisit your risk tolerance and make sure your allocation genuinely reflects how much volatility you can handle, not just in theory, but when the headlines are scary. Cash and CDs. If you have money sitting in cash or short-term CDs earning 4 or 5%, we need to have a conversation. Rates are likely staying elevated for a while, but if and when they do come down, that income goes away. We want to make sure you're not holding more idle cash than you need to be. Roth conversions. We say this a lot, but it's especially relevant right now. If your portfolio took a dip earlier in the year, or if there's been any softness in your account values, that creates a window to convert traditional IRA or 401k dollars to Roth at a lower cost. This is exactly the kind of opportunity that disappears once the market recovers. Tax loss harvesting. Even in a year where the market finishes up, there are almost always positions that are sitting at a loss. Those losses have real value. We can use them to offset gains elsewhere in your portfolio or up to $3,000 of ordinary income. We're actively looking at this across client accounts. Fixed income and bond positioning. This one is really important right now. We just told you that rate cuts in 2026 are largely off the table, and that rates are likely staying at the 3.5 to 3.75% range through the end of the year. That has real implications for how you're positioned in bonds and CDs. If you're sitting in short duration instruments, waiting for rates to drop and reinvesting at lower rates, we may want to look at extending duration to lock in today's yields for longer. On the flip side, if you're in longer duration bonds and rates stay elevated or move higher, that creates price pressure. Either way, this is a conversation worth having. Rates are not coming down on the schedule most people are expected, and your fixed income positioning should reflect that. That's our update. I want to thank you again for your time. We genuinely enjoy doing these, and we hope it's useful to hear us walk through the environment rather than just reading about it. If anything we cover today raises questions about your specific situation, please reach out. That's what we're here for. Give us a call, shoot us an email, or ask us to set up some time. We love to connect. Thanks, everyone.